And we're live with episode 6 of the Tailored Property Wealth podcast. My name is Casey. I'm your host of the podcast. You're going to have to bear with me today. I do have a little bit of maybe the man flu, something going around. So if I sound a little bit more weird than normal, that is why. I've managed to build a multi-million-dollar property portfolio in just a few short years, and I want to inspire and motivate other Australians that if I can do it, so can you. The Tailored Property Wealth podcast has been created to help educate, mentor, coach, and support you through everything relating to property investing to make sure you go out there and make a much better educated decision when investing in property. Please like, share, subscribe, and share this podcast with anyone who you think might see value in it. Episode 6 today, getting into why invest in residential Australian real estate. That's really what we're going to be discussing in a lot of depth. And there's kind of a lot of important parts to note to give you the confidence that residential Australian real estate is something that does perform really well long term. Okay. So I just want to say as well, thank you to everyone reaching out just with the positive feedback around the podcast. It's been really good. People are enjoying it. So if you are, just share it around with anyone you think that might see some value in it. Alrighty. But let's get straight into the episode today because there's some really good stuff to talk about in this one. Now, I guess first off the bat, as long as human beings live on this planet, residential Australian real estate, and over the world, right, residentially, property's going to be a requirement. So that's just something that can give you a lot of confidence. It's not like your shares or your crypto where it's not particularly a necessity, right? But we all need somewhere to live, and because of that, there's always going to be that demand there. Now, on top of that, in Australia, where we have such a beautiful country, things are set up so well that people from other countries are always wanting to move to Australia, and because of that as well, it's going to create that demand on property consistently moving forward, and you can see that right now in the population growth. And people coming in from overseas. All right. So just remember, residential property, especially in Australia, is a necessity, super desirable as part of our country. The next one is that you can use leverage to purchase property, right? And that's where we've discussed it in a past episode, but instead of using, for example, your cash to invest into an asset, you're able to go and use leverage that larger wealth base, and then that compounding effect over time is much more powerful. Now, what do I mean by that? If you take $100,000, okay, and it's generating 5% per year, that would be $5,000, right? Now, if we go out and we use the bank's money with that $100,000 as a 20% deposit on a $500,000 purchase, then all of a sudden that 5% per year on that $500,000 is actually $25,000. All right. So that's where it becomes super, super powerful. Using that leverage, getting that larger wealth base, and then holding long term. And yes, you're going to be holding debt, but if you go back to that first episode where I break down the portfolio, yields are going to increase over time. Inflation will devalue that debt, and then prices will continue to increase, and you'll get to a position where you have a property that has grown substantially in value. It's passively, it's got passive income coming in, and that's where you can use that passive income to push that debt down, or you just hold and let inflation do its thing and devalue that debt. All right. The next one is property is less volatile. All right. So comparing it back to our crypto and our shares, if someone wants to exit out of that asset, they can do that a lot quicker than what they can do with property. So it is a lot less liquid. If someone makes a decision and they want to pull out of property, there is a bit of a process, right? You're going to have to go and speak to agents, probably a couple of agents, get appraisals, find out who you want to work with. They're going to then run a marketing campaign. And depending how long that could take, it could take a number of weeks, let's call it, when properties are selling in the first open at the moment, or it could take longer. It could take a couple of months. And then we've got a settlement after that. Settlement is typically about 6 weeks. So if someone makes that decision to sell, they're not going to get that cash straight away. It's honestly going to be a couple of month process for them to liquidate those assets. And because of that, it means that property is less volatile, right? They can't access those funds straight away. It is that process. It's gonna take a period of time. So it does kind of have that security level on it for that reason. Okay. Next one is you can manufacture equity in properties. And we can do that in a number of different ways. This is more of the active strategy as a property investor, but it's still something that you can do, create more equity, build up that wealth base, leverage into further assets. So it is powerful. It could be just a small renovation, a cosmetic renovation, could be a big renovation, it could be an extension, or it could be a subdivision, or even a development, right? So you have that power where you can go out, purchase an asset, create more equity, use that equity to go again into another purchase. So there are just a couple of obviously different ways there at the moment. Now, the next one that we're getting into is that the Australian economy is super reliant on residential property. And because of that, as an investor or as a property purchaser, it can give us a lot of confidence, because if things do start to go wrong, that's where the Australian government is always going to step in and help out. And we'll go over that in a moment. All right. Now, if we just look purely at some statistics and some data in the past, so CoreLogic at the end of May 2024 has quoted a value of $10.7 trillion is the residential property value in Australia. Massive, massive number. Now, that means that because there's so many different things that are reliant on the property market, some of the biggest companies in Australia are the banks. Banks make their money off property, right? They're not going to let it go backwards substantially. Now, over the last 30 years, we have to remember as well, and this is data from CoreLogic, I think this was released August or October 2022, houses in metro locations have increased 453%, being the highest performing asset class. So over 30 years, the probability of prices, one, going backwards is pretty much slim to none, and two, if you invest, you're going to do really well if you can hold as long as possible, right? So if you're 30 years old, right, go out, purchase a property, wait 20 years, you're 50, that property's well and truly doubled, okay? Now, it's just something to remember when purchasing, right? It just gives you that confidence. And the earlier you get in and purchase property, the earlier you let time do its thing, it's going to be super powerful. So you can use that leverage to build that larger wealth base, right? Now, with how the government intervenes, right? We have seen this in the past. We've seen this just in the last couple of years. And that's more around the inflation side of things. You know, inflation spikes. So what will happen is the RBA pulls a lever, and that lever happens to be the reserve cash rate. So as rates go up, the economy starts to slow down, and we're putting pressure on inflation. And it's just the same thing. We've got APRA out there as well, which are a regulator, and they can influence and change policy in different bits and pieces that affect lending and can slow lending down, or we can speed lending up. I think it was late 2022 off the top of my head as well, is that buffer rate that banks have to use when assessing you as a borrower went from 2.5% to 3%. So just that in itself diminishes borrowing capacity a little bit and then starts to slow things down a little bit more. So there's lots of different levers that they can pull to influence what's happening at the moment with lending, borrowing, and that sort of thing. Okay. So if, for example, we get to a point and there's a bit of a correction nationwide and let's just worst case scenario, it's never happened, right? But let's just say there's a 30% crash. What's going to happen is they're going to start to intervene to be able to get that to correct again. And if you're a property investor investing long term, property does not just go straight up and up and up and up. It'll move, it'll go up, have a growth run, it'll correct it for a bit, and then it will go again. So as an investor, you have to understand that. But based on history, we've never had a crash like that in Australian residential real estate. Even when we had the GFC, there wasn't massive corrections. It was 10 to 15% here in Australia. US, different story, but we have a lot more regulations in place to be able to mitigate that risk from a property perspective here in Australia. And that's why residential Australian property is such a solid asset class. Thank you for listening to this episode of the Tailored Property Wealth Podcast. I hope you're learning lots and getting lots of value out of this episode. If you want to discuss the opportunity of working with us here at Tailored Property Wealth, jump across to the website www.tailoredpropertywealth.com.au, complete the contact form, let us know that you're listening to the Tailored Property Wealth Podcast, and let's reach out, let's have a chat and see how we can help you execute on your property goals. So that one's really, really important to understand as an investor, as a purchaser, because it just, like I said, it mitigates your risk. And if you look at it with that long-term horizon, if you're a 30-year-old and you purchase a property and it does 453% by the time you're 60, you're still earlier than retirement age and you've got an asset that has just grown exponentially in value. Now, if you can go out and make just a couple of purchases, how powerful is that going to be for you as a 60-year-old? All right. So get in, take that action. Don't let interest rates right now scare you, because remember that $450,000 purchase 2 years ago might be $550 now. The $550 purchase now in 12 months' time is going to be $650. Asset hasn't changed itself. Just purely the longer you wait, the more prices will grow, the more you have to borrow for that same asset. The next one is that we fundamentally have a supply and demand issue in this country right now. And in the future episode, we're going to go right into the data on that one, which is going to be super interesting. But right now, we've got massive amounts of population coming into Australia, which is demand. More people coming in, more people competing over the same supply. But what's also happening is we've got builders going into liquidation in massive amounts and administration. We've got people that are having to come over from other countries that are trades and builders, and they're not quality. So that new stock that's coming up isn't as quality as it should be, and that's creating issues. So if we've got demand coming in high amounts, and then we have supply that's being affected from a quality point of view or from just a pure numbers point of view, and it's not keeping up with that supply, what's going to happen is we're going to have a pressure cooker, and it's already happening, that high demand, low supply is going to keep pushing prices higher. There's lots of different things the government's aiming to do at the moment to bring more supply. However, with the pure numbers, it's just going to keep pushing pressure on prices. They're going to continue to go up in value. So understanding that is super crucial. And that's again why we like those metro locations as well. Because if you're getting in those established areas in metro locations, more land cannot be created. So over time, the more population grows, the more scarce that land becomes. The more scarce it becomes, the more it grows and the more higher in value it is. Okay, so super, super powerful. And it's just some simple fundamentals to understand as to why residential Australian real estate is a really strong investment class to invest in. Many millionaires, they first create their wealth in property. Then they can start to go out and they can start to take higher risk in other things, whether they start businesses or whatever that looks like, right? So residential Australian real estate is super, super valuable. We've obviously got a rental crisis going on at the moment, and that kind of leans back into that supply and demand issue. And we could do an episode on this on its own as to a number of different issues that are kind of creating those historic low vacancy rates. Now, if you can go out and purchase an asset, right, and if we could compare this to commercial property where they can sit for long extended periods of time in comparison to many markets we invest in, if not all markets we invest in right now, vacancy rates are under 1%. So what that means is there's super limited supply. So from a marketing point of view and finding a quality tenant, that can become a lot easier. And it just gives you the confidence, right, that if a tenant moves out for whatever reason, we've got low vacancy rates, we can market and we can get a tenant in nice and quickly as well. All right, so there's some really, really positives in this one as to why invest in Australian residential real estate, okay? If you're thinking of investing in real estate, go and just look at some of the history on prices. Look at what the mainstream media have been banging on for 20, 30, 40, 50 years. It's the same narrative. It's the same thing that they're pushing right now. Property prices can't go any higher. It's too expensive, this, that, and the other, right? But if you look back 50 years, that's what they were talking about 50 years ago. And what happened to property prices? They've continued to grow year on year. Obviously, peaks, troughs a little bit, but over 30 years, 453% growth in houses in metro locations. All right. Hindsight is a wonderful thing. And I speak to people all the time that they're like, we were thinking of buying 2, 3, 4 years ago. We didn't. And now we can see how much prices have moved. And that's why we're getting in and taking action now, which is great. People go out and learn a lesson. And it's a painful lesson, unfortunately. But as long as you learn, you get in and you start to get that growth. But you don't want to sit back 20, 30 years' time and go, gee, I wish I'd purchased that property. What would things look like now? And this isn't to go out and purchase just to say we've got all this cash or whatever it is. It's not that. It's going out there and just setting ourselves up financially so that we have more choices, we have more freedom in the future, okay? Look, that's pretty much it. 17, 18 minutes today. Pretty short, sweet one, but it just highlights the importance of why you should invest in residential Australian real estate, why we like it, why we work with it every single day, and that's because long-term it performs and you as an investor are going to set yourself up for success. So thanks for listening. I hope my voice was okay with a little bit of the man flu going on. We will be back with another episode shortly. Thanks for listening. Have a great day, guys. Bye. Thank you for listening to this episode of the podcast. If you don't already, make sure you follow us across all of our social platforms. That can be Instagram, YouTube, LinkedIn, Facebook. I wish you all the best out there on your property investing journey, and I hope each decision you make in purchasing more property gets you closer to your goal of financial freedom.